Hi everybody, this is Gary Dean with Sentiment Timing, and this is our technical video report for Wednesday, April 24th, 2019. So today was the start of Woody's say week period, and we saw the markets down some, then they bid them back up, and by the time the everything closed, the S&P was down 6, so nothing major at all. Looking, I'm going to show you the first charts are this is the internals that I follow. So right now the S&P, you can see the stocks above their 50-day moving average. We have a pretty huge divergence right here, as the S&P is making new highs. This is actually making really not even close to the previous high. So it's saying what it's telling us is less and less stocks are pushing the S&P higher, and as we know, it's actually been in overnight trading. So that's why these internals start to kind of wane like this, is when the majority of the move is done in overnight trading, and then the markets open up and these stocks don't have time to catch up with where the futures are. So that's the reason why we get these divergences. The McClellan summation index, we also have a divergence. Nothing really major, but it's a divergence, and this divergence took place for quite some time before we had the big move. It doesn't always have to be like that. Here's one that didn't take a whole lot of time. It was definitely a little more time than what we saw here, and then we had this huge drop. So we're getting this internals that are starting to crack some, but this is the one that is kind of telling me that the top really isn't in yet, meaning that the drop that we're kind of anticipating through this the weakness time period, the short-term time period, is probably going to come up and make a new high, and this is the advanced decline line, and you can see there's no divergence there. Now this is one that it doesn't mean that we can't get some type of pullback, but it just means that when we don't have a divergence in place, like this was a clear bearish divergence in the advanced decline line, and from here we just saw the markets absolutely collapse. Now we haven't really seen that this entire way. We've been seeing higher highs. So right now, if we get a pullback, it's going to have to be something like this, and then we come up and come down. So it could be 100 point, 50 to 100, or maybe a little bit more. It all depends. Like there was no divergence here, and this was it's kind of hard to tell because this is the S&P stuff. So 2,800, there's about a 100-point drop here. But in any case, this drop most likely is going to find some kind of support and get bid back up, and that's when we'll get the divergence on the advanced decline line. And when that happens, that's when we're anticipating it's most likely going to be entering into that kill zone. So let's take a look at the S&P here, and you can see we're still within this pattern here, even though we haven't really broken any support. It keeps following the top of this wedge right here. We still have these bearish divergences in place, even though this one may have to kind of form another one, but I mean we've had so many of them along the way, and we haven't really had any kind of major drop, and it's still within this range right here. And I mean I don't know if it's going to follow this pattern. It could. It's a reliable pattern, but it's taken its time to happen. But the fact that we're still within this, maybe what happens is we come down and then back up again, and that enters into the kill zone. I'm just guessing right now, but really what this looks like, this kind of does look like consolidation. So if we pop higher, we could see a move back, up to that 29.40 area. But the fact that we have a series of bearish divergences that haven't played out, it means that there's no sure thing that we have that other push up. So if it comes down, really what the bears are going to have to push through is going to be, the first one's going to be the 29, say 25 level, but more importantly, it's probably going to be right here, the 29.13. If they get below that, then I believe they're going to be a reaction trade down to the 28.91, and then down to the 28.66, which is the major bull bear line that I've been pointing out. So this is really what the bears have to get through before you start looking at this target. But the first, really the first thing they need to do is get through the 29.14 and then this 28.91. If, like I said, if they head up, it's at new all-time highs, so we're just really kind of guessing, and I just go by fives on that. So if they make the new highs, look for 29.40. Above that, 29.45. There's really no, no other real targets that you can go off of from resistance. So if we take a look at the daily chart, again, we have these bearish divergences. I've been showing you the wave structure is really very, very mature right now. So this could end at any time. And then if we look at the 15-minute chart, this was the first support level. So you can see the bulls are buying the the 50-day moving average on the 15-minute chart, and they don't have a whole lot of wiggle room. So if this breaks, then we're going to be looking for that move down to the 29.13 support or 29.11. This is in the range here, and then we're looking at that 28.92. So that's really about all I have. The bears need to push it through here. We're in the weak time period. We know that sentiment's been high, and some of the internals are looking for some type of pullback, and really it wouldn't surprise me at all. So with that, let's see what plays out tomorrow. Have a great night, and I'll talk to you guys in the morning.